Hello, everyone. Welcome to CAPIS's monthly research call. Today, we're joined with Markets Policy Partners. This is part of a series that we at CAPIS here host every month for our clients. I'm Ed O'Dowd. Today, I'm joined with John Fagan and Brandon Walsh of Markets Policy Partners. Welcome, gentlemen.
Thanks for hosting us again. It's great to be back.
Great to have you here. This is, like I mentioned, this is part of a series that we do here at CAPIS every month. Last month, we had Fair Lead Strategies, which for those of you on the call, focuses more on technical analysis. And there was some really good, information there from Katie Stockton. Today, I think it's very timely to have Markets Policy Partners on, given all of the kind of data points and what's going on, big picture in the markets, and having these guys on to decipher it. So we last had them in March. I know at the time we were talking about the Fed and will there be another hike? And maybe we had one more hike after that. After the call, they had a hike and then maybe one more after that. But now we're at a point where, as we saw yesterday, the Fed stopped hiking for the first time in well over a year, 15 months, I believe. There's just a lot to kind of go through. The debt ceiling increase, so we're excited. It's really timely to have you guys on. Also, I would say at the end of the call, at the end of the presentation here, which probably will be about 20-25 minutes, give or take, we'll have a time for some questions. So please let us know, if there's anything for John or Brandon, and we can get it in front of them and kind of pivot from there. So with that, welcome, gentlemen. Whoever wants to start, please take it away from here.
Thanks very much. Thanks, everybody, for joining. Yeah, it's to talk about the Fed, most immediate and fresh in the minds of the market. I think there was a sort of a suspicious minds kind of reaction to the Fed's decision and the accompanying projections and communications yesterday. It was there were some internal inconsistencies, some potentially contradictory signals that were going that were flying around. That Chair Powell seemed, not really all that comfortable explaining, and so the sense that just to back it up, market participants and we're going into this alongside economists, thinking that this would be a pause, and that was basically a message that was delivered through the typical Wall Street Journal Wall Street Journal channel. And before that, it had looked like kind of a coin flip. Markets were really debating whether June was going to be another the 11th and the 11th consecutive meeting at which they hike rates, and certainly you could have looked at the data from the prior meeting and said, well, yeah, obviously you could there's plenty in there that you could justify a hike with. By the same token, you could potentially justify a pause as well. But it was really the Fed kind of stuck their neck out and put the marker down through the signaling that it would be a pause. And clearly there was some reflationary dynamics. There was some positivity in risk assets around that, but at the same time there was a sense that the Fed would try to have a little bit both ways, right? They don't want to just give you a dovish signaling, and so that there would have to be some sort of hawkish overtones, and so the idea of a hawkish rather than a dovish hike like we saw at the prior meeting, you get a hawkish hold. And where was that hawkish surprise going to come in? A lot of people circled the dot plot, the projection, the rates projections, as the place in which, within the scope of their communications and accompanying statements and everything, would be most likely to deliver and to hammer home a hawkish message to accompany the pause. And that's what we got. And it was kind of an eye-catchingly hawkish upgrade in the dots. Two more rate hikes essentially in the median priced in. When asked, and then you get into that sort of uncomfortable questioning. Well, if you got between the last, between March and now, what did you see that added 2 rate hikes, but that made you want to pause in June at the same time? So it was, and clearly there was a sense in the financial markets and among observers that maybe there was a little bit of gamesmanship, a little bit of performative hawkishness in these dots, and that ultimately played out in the market not really responding that much. When you look at Fed fund futures now, it's really not that different. The pricing is still kind of a kiss goodbye rate hike in the July meeting, and then basically on hold. Some of the odds of another rate hike have gone up, but for the most part, the base case stayed the same. One more in July, and then on hold. The big change, one of the big changes we've seen over the past couple of weeks is that rate cuts have been priced out. I think that's where the Fed has been very successful in communicating. But we'll talk a little bit more about this in a bit. If economic data begins to soften more, more broadly, more clearly, more across the board, you get some additional softening in the labor market, and the consumers sort of tire out and fatigue a little bit further in the back half of this year. That's where those expectations for rate cuts are going to creep back in, and that's where we see the Fed and the market, potentially on a collision course. Brendan, what was your what were some other aspects that you saw in the Fed decision that we should remark upon?
Well, I definitely think you're right that they almost should get rid of the dot plot because it's confusing things as we are. They're not going to do it, but it makes that communication that, basically they wanted to take a pause because there's a lot of uncertainty out there. But I think they also have an issue because the next meeting is only 6 weeks away. I'm not sure exactly how different the world's going to be and how much more you're going to understand in 6 weeks that says we should raise 25 when you held here. So once you pause, it's hard to kind of start it up again, especially when your end goal is only slightly higher than it is. I think the one risk to the outlook is definitely in the commercial real estate market. It's a slow moving train wreck, but it's definitely starting to happen. You're already seeing, like Morgan Stanley said, they're not making any commercial real estate loans. And the issue for that is, everyone who, it's not really fully an economic issue, it's a work from home issue, where the reality is, probably about a third of downtown, big city commercial real estate is obsolete. No one's ever going to go into it. So the companies that are renting, are perfectly fine. So they're not going to default on their loan. They're just going to wait till it rolls off. But then what we're seeing is happening is that company then goes into prime real estate. They're taking half the footprint that they used to because they still want to try to get people in the office at least 3 days a week, but they don't need the size they did. And they want to have a more awesome office to lure people back. So, there's really no bid for any of these properties because what we're seeing is, the bank doesn't want it. So as soon as the bank gets it, they sell it for whatever the land underneath the building's worth. So we have a lot of issues going on in the commercial real estate market, but it's a slow moving train wreck because it just takes time for that to roll off. But I think it's something the Fed's understanding more and more, and also something that the market's slightly starting to come to realization for. So I think if I'm the Fed, I'm much more worried about holding rates steady like I promised than maybe trying to eke out another 25, to save face or whatever.
And that's really and you hit the nail on the head there, Brendan. That's really the crux of our macro view over the back half of this year and into early 2024 is essentially the Feds, they may not go up. Our base case is that the inertia sets in and they actually stay on hold, but at this level. But essentially, one more hike is essentially academic at this point. But where we see that plateauing, we see that staying fixed into 2024, whether the economy holds up and avoids a recession or whether it goes into a recession. Yeah. And that really is where the big differentiator in the macro landscape is going to be. It's going to be down to, we don't think that the Fed's policy is going to change that much in either circumstance, but the market obviously will, if the economy starts to slow, those rate cuts will be priced back in to Fed fund futures, and the Fed is going to be, I think, very much, lashed to the mast like Ulysses, right? They're going to say, we don't care. Inflation's coming down. We're not cutting. Growth is falling. Growth is deteriorating. We're not cutting. We've seen increasing problems in the commercial real estate market, and the Fed is going to be saying, believe us, we're still not cutting.
Yeah.
And that
the way
is,
that the commercial real estate is it's going to be a slow moving rolling disaster, not like in '07 when we woke up and just everyone's house was worthless. So they're going to be much more stubborn on the commercial real estate, even though losses could be massive. It's going to take place over, the next couple of years.
right. And part of this is our expected reaction function for the Fed. And Chair Powell said it yesterday. I mean, basically trying to emphasize, downplay whether they're going a little bit higher, downplaying the dots, and that's, as he should do. But the emphasis really is, we are not cutting rates. They are the lesson they learned from the Volcker years is do not cut too soon. Volcker doesn't necessarily tell you how, where the terminal rate needs to be to battle inflation. But what Volcker does tell you is don't cut too soon. Be the tough guy. Hang in there. And if you reverse yourself too soon, the inflation genie gets back out of the bottle and it's harder to put it in the second time. And we think that the Fed will be absolutely terrified to reverse the gains that it has made on inflation suppression by cutting too soon, easing too soon, even in the face of relatively significant downturns in growth and deterioration in the labor market. Ultimately, we think that the labor market deterioration will be limited by the fact that there's still it's still a tight labor, it's still shortage of workers, and it's very. This is a checkerboard economy at this point. You've got pockets of recession and pockets of expansion and growth. And so it won't be particularly, in our view, a particularly, deep recession, but we think that it will be, perhaps relatively lengthy and followed by a substandard rebound because of the lack of monetary policy support and fiscal stimulus to reawaken animal spirits in the economy down the road. Now, where we'd be wrong, if we've been wrong up until now, on the economy, we thought we would see more pronounced weakness by this point in the year, and I think, like a lot of macro strategists and economists, we've been surprised at the resilience of the U.S. economy overall, and maybe that continues to surprise us. But we think that the U.S. consumer is a big heavyweight fighter. But they've been taking a lot of body blows. They're not going to take a knockout blow, but with inflation and we'll talk a little bit more about the student loan repayments kicking back off in the spring. They're getting softened up by a lot of body blows, and we think that the vitality and fortitude of the U.S. consumer is going to flag more significantly through the back half of this year in 2024.
Yeah, that's a really good point on the student loan. That is definitely happening. It's just costing the administration too much money, and part of the debt deal was that you basically have to start collecting again. So it's not the end of the world, but the consumer has gotten used to not paying that $300-400 a month, and they're going to have to start doing it again, which doesn't necessarily mean we have to fall off a cliff, but it's going to be a drag on the consumer.
Yeah, and and Chair Powell said it in his press conference a number of times. They really don't know the impact of the credit tight. They are assuming that credit tightening from the Silicon Valley Bank and other bank failure issues, that is going to be coming through. It's lagged effect. It will be, it's certainly not being fully felt right now, and they're wondering to see what that looks like. You're seeing, when you look across the indicators, you see upside surprises and a lot of like headline numbers, but you see some, if you look under the hood, you can see certainly signs of weakness. Now, some of this is confirmation bias is on our side. Last week, we did a confirmation bias special in our Friday publication of things that we were looking at because we're expecting a recession later this year. Things like cyclical stocks in general. Everybody knows the stock market's really been pulled up by the sort of AI boomlet and some the large tech stock dominance. And when you look at some of the other more cyclical and real economy sectors, it's not looking quite as great. Truck tonnage index we included. They've been passing around the cardboard box demand is the lowest since the global financial crisis. You're looking at continuing claims are jumping in a lot of states, and that's how it begins and broadens out. If you look further up the supply chain, if you're looking at I used to cover Asia when we were at the hedge fund, and looking at the exports out of South Korea and Taiwan, these like way up the supply chain, those look awful. They're so
Yeah.
bad. And
And even just the last 24 hours in terms of central banks has been very kind of indicative of what's going on in the world. China, cut rates again last night after a very, very disappointing global data. So the reopening of China and that being off to the races just really isn't happening, and their exports are kind of disappointing. Then this morning we had the ECB hike another 25 basis points because their inflation rate is too high, but their growth rate is also negative. They had two, slightly negative fourth quarter and first quarter. So you're seeing poor growth in Europe along with tightening, and you're seeing China kind of trying to push on a wet noodle to try to stimulate an economy that is having a hard time getting going.
We never miss an opportunity, and we'll go back to the U.S. Economic and talk about the debt ceiling and so forth, the fiscal outlook later. But we never miss an opportunity to say, to reiterate our view on China, that the COVID reopening story and the stimulus kicker that Beijing had added with the 16-point property support plan, all that would end up in disappointment. It's a great story, fantastic. You can ride a little trade on that, but as we've seen with China, their equity markets are not a buy and hold market. This is a mean reversion machine. They always disappoint when it comes to the impact of stimulus, because this is a gigantic. They have just an enormous reservoir of unrealized losses in this economy, and it's essentially a money burning machine. So it just they have to run faster to stand still, and the fundamentals of the economy don't look great. The U.S. is not about to, in our view, open up a big episode of détente and softening to China, a big thaw. Anthony Blinken, Secretary of State Blinken's trip is important. It's meaningful, but we don't think it's anything in the way of a change, a sea change in the policy posture. We think that the Biden administration has been very tough on China, will continue to be so, and the political calculus for them to ease off Beijing before the 2024 election just isn't there. So there was a story earlier this week. Oh, they're letting South Korean and Taiwanese chip makers continue to build plants in China. The U.S. isn't saying no. Well, I mean, they're only those are for specific chips, right? And the limitation of that's a very measured and judicious, but also well within the bounds of U.S. government policy objectives in this space. We don't think it marks any sort of deviation from where the real direction of travel, which is to continue to choke off the most advanced technology and chips from China, and basically impede impede their ability to try to catch up on that front. Second, but watch this space. If there is a second Biden term, that might be the time where you would have the potential. You may not get a lot of legislation done in a Biden second term. Second terms are usually relatively squishy on the legislative side, but without that overhang of having to run again, the Biden administration might begin to be more creative about how to engage China and offer some carrots along with some sticks. So watch this space. That might be something, but that's quite a bit down the road. Let's see. Going back to the economic. U.S. economic outlook, yeah, as we've said, around the world, it's pretty soft. China is not the growth engine. U.S. is outperforming for now, but we expect a more clear slowdown from the kind of muddled mixed signals and cross currents that we have right now in the back half of the year. But we don't expect the Fed to be anything but on hold and staunchly on hold in the face of that. Oil prices, we've been relatively, given our view on China and sort of a dim view on global growth, we have not been bulls on oil, but we think that the bottom, we thought the bottom would stay pretty close to like 80 on Brent and WTI. The bottom's gone a lot further down than we thought. But OPEC gets frisky at these levels, and Saudi Arabia has bent over backwards. We think they'll continue to do that. It's sort of a war of words between OPEC and the International Energy Agency. It's like, one keeps publishing bullish and the other bearish stuff, but the Saudis have shown a determined willingness to do what needs to be done and shoulder it unilaterally. So we think that they stay on board. Obviously, the Biden administration has to fill up the SPR. Again, that is, I believe that's begun, or is at least the process. The process of getting that in train. And they said they would fill below 80. Look where the prices are. So it's time to get on that. So we're not bulls on oil and commodities by any stretch of the imagination, given where we think China is going to. We think this new stimulus talk in China isn't going to pan out in any particular way on the growth side. But we think oil has a floor, and we think that sticky energy prices are going to be part of the higher for longer rates accompanying higher for longer inflation. We think that inflation will stay kind of sticky, even as the improvements continue over the back half of this year. Let's see. On the debt ceiling, I guess we would say that it was kind of like surprisingly successful. And the Congress is a mess. Everyone knows it. But when you step back and you look at, despite this, the partisan warfare in Washington, D.C., the Biden administration, there have been a lot of bipartisan bills and a lot of cooperation on the things that everybody can agree on, like infrastructure, and that's encouraging. And you get a situation in which the sort of moderate impulses really found the common ground and managed to steady the ship in this. So you don't want to make too much of it.
McCarthy walked out much stronger, where there was fears that if he did cut a bipartisan deal, that the extreme part of the Republican Party would try to replace him, and they did, and it lasted a day, and it didn't go anywhere. So he's certainly strengthened from this experience.
Yeah, they're torturing him with this legislative stuff right now, but I don't think that the far right of the caucus has staying power on that. So ultimately, that's a demonstration. If they were seriously going to cut the knees out from under McCarthy, they would just have him removed. Right.
Yeah, exactly.
So doing some legislative stunts and showing how tough they are is, in some ways, I think more just it's posturing, it's for the cameras, and when as a little protest after the debt ceiling. But we think that it ultimately sort of fizzles out, and McCarthy soldiers on in this role. As Brendan said, we think he's strengthened. So let's see. I guess we'll pause there for questions, and then Brendan and I can think of any last thoughts, or feel free to ask us
Thank you.
anything you want.
Great. If there's any questions, you can enter them into the chat there. Any questions at all from the audience? I'm glad you ended with the debt ceiling there. Something I was thinking of when that was successful and went through was, raising the debt ceiling, and then the obvious is the ongoing debt service. It's just, what is if you have an opinion or a view of what could be a long-term impact on taxes, revenues to meet debt service? It's just, something we can't ignore. Like, what is your, I guess, view on tax policy potentially for debt service? And then also, how much does this deficit matter, big picture, long term? Do you have a view on that?
Yeah, absolutely. So I think that there's a sense that I think there's a prevailing sense in markets that rates are going to come back down, and that we are going to revert to sort of a pre-COVID, a relatively close to pre-COVID form. Maybe not zero interest rates, but you end up with interest rates coming back down, drifting lower. And this is not necessarily an inflationary economy. There are a lot of deflationary forces and demographics and so on and so forth. The technology, AI, it's deflationary and so on and so forth. So I think that there's sort of that, there's that as kind of a dodge. You get to, you don't have to deal with the, debt service, and persistently high debt service is a question if you just assume that rates are going to come back down. So that's, I think that's one way to go about it. I think the other is, when you think of our view is that rates are going to stay at a higher plane, and that fiscal challenges are we've seen the two sides square off, and just nothing really gets done on that front, and there's no constituency for cutting entitlements, because as soon as it's something that you have to link arms and do it, right, and you certainly cannot do that in the current environment, the current political environment. Who knows, after the 2024 election, all bets are off, and you never know what is going to happen. That's a total wild card. But right now, at least, any sort of serious deficit reduction, in the current world, are you going to slash defense spending? No, you're not. Are you going to attack entitlements when you're looking at an incredibly high stakes election in 2024 for both parties? Definitely not. And so, there's no answer there. And when you look at the Treasury market, it's, what we've seen time and time again is the Treasury market sort of allows policymakers to get away with it, right? The bond vigilantes are long gone from the landscape. And when you look across at Liz Truss and the unfortunate circumstance of UK gilts, when there's like a big problem, they had an emerging markets kind of reaction. Their currency, bonds, and domestic assets all sold off. We don't have that yet. Maybe we get there eventually, but we still don't have that. The Treasury market is still the Treasury market is still whether it's the regulated demand, whether it's just the attractive yields, that sort of thing. There's just it's not holding anybody's feet to the fire right now.
Okay. All right. So you just see it kind of rolling, as you will, as you would say, just, we'll meet the debt service, but the reality is some of the big ones, defense, obviously Medicare, Social Security they're not touchable realistically.
Not before the 2024 election.
Well, and then also with the demographics of, how many people are retiring every day in America and getting onto Medicare and Social Security, there's too much of a voting block there that it just seems more untouchable than ever. I don't know if you agree on that, but yeah.
Yeah, I mean, before the negotiations, Trump took Social Security and Medicaid off the table for the Republicans. So if the Republicans aren't going to fight it, the Democrats are going to lead the charge.
Yeah. I mean, Trump is obviously he understands which way the political winds are blowing as well as anybody, and he knows that Democrats are just like desperate for Republicans to walk into this trap ahead of 2024. That's the way Democrats see it. And there's a lot of the party that seemed very willing to jump into that briar patch. but I think President Trump talked him out of that, and former President Trump talked him out of that, and there's and now where's your constituency for cutting? Essentially, the constituency would be Trump's the kind of guy that would say, I'm not going to touch entitlements, and then if he comes in, maybe he touches entitlements, but who knows? It's he's obviously a mercurial operator.
Absolutely. All right. Well, I don't think I see any questions here. You guys did a fantastic job of kind of, from my view, covering everything. I was saying to Brandon and you when you jumped on the call, how timely it is to have you guys on today. It seems like the timing, the last couple of calls with you has been the right time when there's been just so much going on. But really with what you guys do, it has been the right time for a while now. You have to kind of take the big picture look and see the policy that's happening and what's the impact on the markets. So we enjoyed having you on, and I appreciate everyone joining us, CAPIS clients, friends of the firm. Anybody that is interested in what John and Brandon have to say here, and maybe would like to form a relationship to get it more tailored to your kind of investment portfolios and the way you manage money and look at the research, we can get you in touch with them. Reach out to your sales coverage or just reach out to the firm, and we can get you in touch with John and Brandon.
Yeah, or jump
absolutely.
on marketspolicy.com.
There you go.
And,
There you go. Great website. Yeah, we
get
encourage
that
you to do
plug
that. Next month, we will have another call. I believe it's going to be Thursday, July 20th. We will reach out to everyone on that. And again, thank you so much. I think it's JC Peretz, but we'll confirm that in email when we reach out to everybody. But I appreciate everyone joining us on the call today. And guys, thank you so much. It was fun.
Thanks for having us. Always enjoy it.
All right. Take care. Bye-bye, everyone. Have a great week. Have a great week. Bye-bye.